So I think it's going to be, it's already happening right now. So let's look at gold. ETF holdings are up 10% this year. For the last 4 years, they've been down every single year. So that's a substantial shift in sentiment. So there is a lot of that. I think any smart, astute investors who are getting way overweight equities, certainly US dollar denominated equities, now they're expanding overseas into other assets. What's the simplest one that's kind of outside of the dollar in this country is gold. Now, I've heard this from many sources that you take those expensive dollars and US assets and diversify. What accelerates that? The key thing I point out is that gold as we speak right now is just below $3,400 an ounce. It's hovering around there. Traded their first in April. That's 5 months in a row unchanged. It's a bull flag, just waiting for excuse to go higher. And I think the excuse will be stock market going down. But gold seems to be front running a little bit. Again, we have central banks buying, but I do love the World Gold Council's data on that, where they point out central banks have curtailed their buying. 3 years in a row, they bought over 1,000, and the responsive supply is not really kicking in. It takes a while. So I still think gold's an enduring bull market. It's just a little stretched. It's a matter of time it breaks out above 3,500, gets to 4,000. A key catalyst will be when the U.S. stock market gives back some of its gains. And that, to me, is the key thing that the Fed and the bond yields and everything are waiting for. I look at the bond market right now as a very nice, not so much nice, well, on U.S. stock market. U.S. Treasury long bonds, that long bond, 4.8%. The high for this year was 5.15. That happened right about the same time Bitcoin made a new high, 117, and came back. You see that tilt there? Risk assets go up, yields go up, and they go down. But this is a problem right now with the Fed. They're in a bit of a pickle. They will ease at some point. It's priced in the market. But they have to have that. I think that's the smart thing to do is let the markets tell them to ease. They made a mistake last time of easing and too much, which was last year. Eased 4 times, 425 basis point cuts, and bond yields spiked and said, stop. This is not good. Stock market blasted off and said, yeah, this is great. We love when you add liquor to the punch bowl at the party. And that's the mistake they made. They don't say it, but any astute investor gets it and knows that that's the biggest risk is they pump up risk assets too much. It creates more and more inflation. The wealth effect accelerates. And that's the problem we are right now. We still have sticky inflation. Duh, what do you expect? And then, of course, we have the U.S. government deficit spending at 7% of GDP, which is quite expensive. So to me, the next big trade will be gold making a new high, T-bonds catching up, Fed easing, bond yields declining, kick in and stay that way is for U.S. stock market to go down. If it stays up, it's not going to last long. Yields won't go down much. Fed can't ease much. Stock market is basically so elevated here. It's just a matter of time it starts taking back some of that wealth effect. So it's also the key thing. You look at all the sentiment data, look at consumer spending in this country is basically flat over a 6-month period, which is not good. But look at construction spending; it's actually turned lower. It's downward. All the unemployment data, and it's not just the stuff that Mr. Trump pushed back. It's all heading lower, and unemployment heading lower, ADP heading lower. They're all heading that way, and all just waiting for the next catalyst. The key thing is what got us to this point where they're heading lower from. What plateau is it from? One of the biggest spikes in history, and that's my point. Is I have to look at historical context of from where we're going, and I think this year, and then narrowing down to just a few months from signals. Yeah, okay. Well, I didn't think we bounced this much this year. But now it's really about they can show more animal spirits and takes the Fed out of the easing picture, but they're also showing very significant, I would say, diverse weakness, and I expect that to accelerate as we revert. So let's give an example of the Fed movie. Firstly, they moved way too much, not just the Fed, but 5 years ago we all thought we could die. We had a real reason for massive liquidity pump in the system, and then we didn't take it away fast enough. We did come up with vaccines within 6 months. I mean, human nature, with a little bit of necessity, invented things, but the S&P 500 started making new highs at the end of 2020, beginning of 2021. That's when the Fed should have started tightening. They were way too late. They started in 22, way far behind. Anybody trading money knew back then, like, oh, thank you. They're just pumping the system. And the problem is now they have to be late. Because they were way so late then, everything's so pumped up now. The key thing is their job to just save the stock market every time it moves. When unemployment starts ticking up, it will. But at 4.2% right now, the unemployment rate for the last 12 months, the volatility of that change last 12 months is the lowest since 2002. So it's just stuck. I mean, I look at it, it's a bull flag. Unemployment goes up and sticks there. It looks like gold, except gold's at new highs. So just wait for the next step to go higher. And what we're seeing happening with some of the latest data, what's happening in construction spending, consumer sentiment, is consumer spending kicking in. But what shuts off that is the stock market. I mean, that's to me, it's what really pushed it up. So I don't, I hope it's different this time, but I just point out the facts that people need to recognize and realize that people are so addicted to stock market just goes up. I mean, I love hearing it from some of the younger people, and nothing wrong with being half my age, which is around 30. I'm saying in recessions will never happen again. There's only a few times in history you hear statements like that, and every time I've heard things like that, and obviously I've only been around for a while, and what I've read about other people hearing is usually it means you should be worried about the other indications is we've reached, I think, the plateau of the Fed started easing for stock market crashes in 1987, and actually before that, they actually started doing stuff well before that, but that's the most significant one. Now we've lifted things so high that every time we have a problem, the Fed's supposed to save us, and they will, but I think what we're going to start now is a cat and mouse game between normalization of very expensive equities, Sure, they've got good reasons. Got earnings from tech, but the concentration risk is the highest ever. And the cat and mouse game before the Fed easing and normalization of risk assets, and this could last for a long time. The question is, how low does it go? Now, it's already happening in China. China's running almost 300% debt to GDP. The 10-year note yields at 1.7%. And the latest PPI readings minus 3.6%. Wow. Same thing happened in Japan. I just, they're turning Japanese, and the whole world right now is resting on the U.S. stock market staying elevated, and that's why there's so much risk. And so I'll end with the most significant systematic risk I think in the system I've ever seen of one simple little market. He hated them before. He hated an asset that went for the U.S. dollar as its base layer. I was kind of thought that was silly, and it invested in treasuries. I thought that was kind of silly, but now he figured it out. And this space helped him get elected. But does it get any better now? And now the whole space is completely dependent on one person versus before it was more dependent on things like organic adoption and everything. So I think that's the key risk is Bitcoin could lead everything, and I think that's why I can't be bullish along it, because I think the risk goes down and takes the system with it. I'm glad you went to the dollar. The Bloomberg Dollar Spot Index is down about 8% on the year. Let's just not forget, it was at an all-time high last year, just like the S&P 500 versus the MSCI ex-US index. It's the same trade. It's been that same trade, that stock market versus the rest of the world stock markets and the dollar since the bottom in 2009. And they both have tilted down a little bit. But they were so high that they have so much room for reversion. So the key thing I'm worried about with the dollar is that what pushed it up, U.S. stock market, is going to push it back down. And it's just so expensive. But it's also how you measure the dollar versus other fiat currencies. 5%, and as a stock market that's booming, except the problem is it's just so expensive. Most expensive in history versus most other equity markets. So key thing I'm worried about is the dollar is going to go back down with that. I think it's also a vested interest of our president who wants to rebalance global trade to have a weak dollar. They won't not say it so much, but to weaken a little bit, give back some of those extraordinary gains of the last. But one thing I want to point out I think is very, very positive for and very counter de-dollarization is what's happening with crypto dollars. People call them stable coins. There's a significant proliferation of stable coins, 250 billion or so now. Scott Bassett said it's going to drop over probably 10x, and who knows what period. I think he mentioned 3 billion. I don't see why not. It's just a better way to transact. And once they figure out how to be able to pay interest, which is just a matter of time, it's just a better way to, you should be able to transact dollars globally like you can email. And I think we're getting there, but it also proves, key thing I think that's remember in this space. So it proves how I think with the dollar, a lot of countries who now you can download a wallet and get access to the US dollar via your phone, and the average phone in India now you can get for $12. Any major country that has currency debasement issues, which we all know the major suspects: Venezuela, Argentina, Turkey. You just keep listing them down.
Of Africa.
Yeah, everything. They're going to, every citizen's going to say, well, sure, thank you, but I can get access to the dollar now. I'm safe, at least safer. I can protect some of my assets. Why would they use Bitcoin in that environment? Take a lot of risk. Now they use it now because it's maybe about as volatile as their own currency, but then they're taking extraordinary risk. You can get to the dollar. So to me, what's happening in this space is it proves the world's adopting dollars via stablecoins. These things are investing in U.S. treasuries, but it also proves that Bitcoin white paper that said it's peer-to-peer cash is not true. It's digital gold, highly speculative, highly correlated to the stock market, but as far as peer-to-peer cash, you can use stablecoins now for that, at least getting to that point, which means de-dollarization is a myth, I think, to some extent. What we have seen is because of the war, is a major shift to gold. I mean, this third largest holding now, central banks, dollar, euro, and now gold. Gold is picking up, but it keeps gold, I think, particularly if the U.S. stock market goes down. And I'll end with this. I think this president we have has been called the crypto president. I think it's going to go down in history as the golden president so far this year. His first full term, Bitcoin's up 30%. I'm sorry, gold's up 30%. Bitcoin's up 20%. That's despite the stock market being up. And I think I'll end with also the quote from Edward Chancellor, former UK Prime Minister: what we generally anticipate does not occur. Everybody expects one thing. Yeah, so you might be, you look at Tether, the largest crypto dollar, 160 billion. I hear the total is about 250 billion now. Virtually all that money came organically from cryptos and all invested in treasury. So this is a wonderful sign that I remember I loved writing about during Trump administration 1.0. So what are you not getting about how cool this space is? They're going for the dollar. They're going for treasuries. And once he figured out I could get elected, okay. But the key thing to remember is as we improves and we get the regulation, it's not like that money just comes out of nowhere. It shifts from other areas. I mean, I remember Laura Shin and Unchained did a podcast with Cy Sheffield of Visa. Gosh, it was 5 years ago. And he was, the corporate Visa. And he said, yeah, crypto dollars are great. We can transmit, transact, and close out our dollar balances instantly. Why would we not do that once we could eliminate the risk? I mean, this is our business. So I think that's a key thing to remember. It's not just going to be organic developed from the crypto space. It's going to come from other spaces. This is a better way to transmit, transact, and hold your dollars. It's getting there. I remember I came from futures background. I've seen this. And I remember being in the trading pits on the phones with guys in New York, and they would be so mad when the treasury futures would move treasuries. And I'm like, sorry, but this is just the new world. You can get leveraged and it's easy. It's all, well, now it's all electronic. So that's the way I see it. But the key, the bottom line is the technology is overwhelming. It's the tokenization of all assets. Right now, we have treasuries somewhat getting tokenized. Next thing is going to be probably, I'm sorry, we have the dollar tokenized. Next thing is going to be treasuries and then stocks. When you can get it all on chain and within the same system, you can arb stuff that has earnings or returns, and you arb between the two, and you can make a little money on the arb. You're going to do that. But then you look over at things like Dogecoin that are worth $930 billion and track nothing and mean nothing. That's going to be short bait. To me, that's what's going to happen. It's going to just put the adults in the room, and that's what's happening with Bitcoin. It's adulting. The minute when futures were launched in 2017, that was a really drop since, and now that's an ETF space. It's major adulting, and we have such a pile-on of people expecting outsized returns. That's not going to go out so well. There's going to be a issue. But one thing to point out is the annual volatility, 260-day volatility of Bitcoin is now about 2 times gold. That's the lowest in history, and I think it's going to maybe spike a little bit in the short term, but continue to head lower as this whole space becomes in the mainstream. And the key thing is the outside returns that people got used to in the past, the insiders, the people who figured it out early, are getting out, and all the people expecting some returns, those same returns, despite lower volatility. And towards the end of the game, rapidly advancing technology and risk assets that history always proves they go up really fast. It's also that, and just being a student of history and markets. It just so I had an argument recently about someone saying, "Oh, Bitcoin sentiment isn't bullish." I'm like, "Have you seen the chart? The number one way to test sentiment is just look at the price." It's just start there, and then you're trying to dig into more details like commitment of traders and everything else that people like watch. But just look at the price. That will tell you exactly what the sentiment is, and look at it over time. It's the number one thing that got me bearish crude oil. Now, technically, and then fundamentals backed it up in 2022 when it pumped to 130. I'm like, this is just the seeds of going back to 150. Always be careful when people are on one side of the boat. You want to tilt the other side. And it's also from an options trader. You never really get optionality when you're on the consensus, but you can get an option to put on a position, get 10x. When you're briefly against the consensus, you get cheap prices to do that. And that's what I think I'm tilting my optionality right now, certainly against consensus. And it's becoming very much consensus to be bullish gold, which is a bit scary, but it looks that way. But it's also the lessons of markets and history, and particularly when you get to such extremes. And I just feel like my colleague Gina Martin Adams just quoted, we're in manic mode in stocks at the moment. And that could last for a while. Trying to short that, negative deltas, okay, you can figure that out, maybe not lose as much, but it's a key trigger you have to keep in mind for what that means when it starts backing up for other assets. And then I look at for all the indications. What used to be a best leading indicator for all risk assets was the ratio of the ounces of gold for one Bitcoin. That Bitcoin to gold ratio, I really started jumping on board. It was around 2017 when it went above 1 for the first time, and it popped up to 40 last year. So far, the range has been around 25 to 40. That's right now, it's about 34 ounces of gold per one Bitcoin. I think the risk is it goes back down. But that indicator was a great leading indicator, and it makes sense. We have this new guard, in an up market, and it had a high correlation to the stock market. But for the last 4 years now, stock market's making highs, but that Bitcoin to gold ratio is flattened out. To me, that's a warning signal. Now, sure, I could be wrong. The Bitcoin gold ratio could catch up, but all my indications are, now that we see this so much hubris and sentiment and people like Michael Saylor doubling down on one of the best trades in history, I just look at it from the future, Tom. I think, how's my book going to read? Is it going to read it was different this time? Or is it going to read, yeah, it was just a matter of time. It's just picking the timing is harder to do. It's one of the hardest things for us to do as humans. I am guilty. I admit it. I admit it. But when I start thinking I'm smart about markets, I'm getting it right, I usually get stopped out. I've learned that lesson. I had a former boss who hired me. He said, "Mike, you say a lot better than you do." I'm like, "Yes." So now all I do is say it. Complete respect for you and for our listeners and our viewers who actually do it. Maybe it's better than I stay in the sidelines. I'm just overweight risk-off assets. I can't deny that. We can't. So we have compliance to check everything. And when you're holding treasuries, it's not really to do with compliance. But that's the key thing to remember is what's the measure of that sentiment? And I see some of the extremes I've ever seen, certainly things like cryptos. And the key thing, the reason I posted that was from John Erkland. He was one of our former anchors based in Toronto for Bloomberg. But there's so many people now comparing Bitcoin to Amazon. I'm like, absolutely. The absolute wrong comparison, because Amazon in 1999, based on that Barron's article, was hated. People gave up on it or stopped out and most widely hated. When you have an asset like Bitcoin that's endorsed by a president, virtually everybody in administration owns it and loves it, and everybody's starting to buy it, probably better not to join the party here, because it's just what we generally anticipate does not occur. Oh, I really enjoy your questions. I think we nailed it. It's the key thing. I hope, Tom, is the key thing that's unique about what I do at Bloomberg Intelligence. I'm allowed to express my opinion. I've been buy side, sell side. Certainly on the sell side, you have to support the firm. The buy side, you talk to your firm. The unique thing about here is I just write what I think, and as long as I'm not being an idiot with my language, my grammar, they're okay with it. So I think that's a benefit. And by the end of the year, if people come in and say, "Mike, you were wrong," that would be delightful. The problem is just all of us need to think about. Just think if by the end of the year we have a little bit of a down year for the stock market, that could be the beginning of a next big trade, which I still think is tilted towards simple risk off. It's like treasury bonds, which some people would say is a risk on asset, but if you hold a maturity, they're not risk. Well, that's the key thing too. It's virtually guaranteed. Every trader on the planet knows you get corrections as you get through August and September and October. It's just the trade is 5% correction S&P 500. It's so completely broadcast. It should happen, particularly when you have volatility in S&P 500 dropping to 7.2%, the lowest in about 5 years. Yeah, it picks up, but it's what happens after that. And we should get the correction in the bounce. And I try to stay away from the bigger picture and try not to get sucked into. It's the bigger picture that matters. I'm just looking towards the end of the year. We basically need to be here or higher, or my scenario's already kicking in, and I see that like the key indicator has been gold and what's happening in China, and gold and bond yields in China. Those are key things that show severe deflation kicking in.